you're trying to buy for pennies and sell for dollars. Definitely lots of businesses out there that are struggling in that, in that 100 to 500,000, but then you're kind of pretty much on your own to turn it around.
You know how some people flip houses? Yeah, that's how Michael Yarmo flips businesses. Anything from consumer goods to biotech to construction. And the crazy thing is, he doesn't even have a background in any of those. In this fascinating conversation, we talk about how he got into flipping businesses, the 80-20 of turning businesses around quickly, and opportunities he's seeing right now because of COVID. So without further ado, here's Michael Yarmo. Okay, we have Michael Yarmo today on the show. Michael, how's it going?
Hey, Gabriel. Thanks for having me on. Great to be here with you.
I'm very excited about today's episode because today is all about flipping and fixing businesses. Before we start, maybe you can give our audience a little background on, the last couple of years of, your professional biography and how you got into fixing businesses.
Yes. So I'm a managing partner with a distressed turnaround firm called New Point Advisors. We're out of Chicago, but we've got offices kind of all over North America. Basically, what we do is we're working with smaller businesses. So let's call them $100 million in revenue or less. We're either working alongside management or replacing management on behalf of the ownership stack. So that would be private equity companies, or even the debtor stack, which is banks and other financing companies. So these companies have ended up in some type of distress. The current stack, debt or ownership doesn't know how to fix it. They don't want to lose out on their investment, so they call us in to fix the business. And sometimes we actually may have to completely replace management if that's what the situation calls for. Currently I'm CEO on a couple of firms right now where we're trying to turn the business around. And ultimately, we have a mandate of, let's call it 100 to 200 days to go in, run our process through, get the business fixed, profitable, and cash stable again, and then kind of hand it off to a more long-term management, and then we're on to the next fire. I entered the space through I was actually doing it with my own capital and with my own LP partners. We had actually bought a distressed food distributor who had been in business for about 20 years, had not really innovated or kind of kept up with the times, and watched a lot of their market share kind of get washed away from more aggressive competitors, either more aggressive on price or with new products, or new technology on how to gather and process orders. So they were really just kind of on their last legs. Still enough of a customer base for us to come in and at least see it through a turnaround phase. We learned very quickly that the channels that they were selling through and the inventory they were carrying was just too low of an gross margin to really make the business work. So we actually quickly pivoted the business into areas that we thought had much more upside and much higher margins, which was going from a bakery distribution business to a frozen foods distribution business. We quickly gained some real traction. We had to upgrade a lot of the assets, whether it be the warehouse or the trucks, get new suppliers in there and a new customer stack to sell into. But we were successful with it, and then ended up doing a whole bunch of tack-on acquisitions to kind of help grow the business without having to add any more hardcore assets or capital expenditures. And then ended up getting an offer from a competitor about 5 years later, and it ended up selling off the business.
Okay.
So
okay. Can I just jump in here real quick?
Yeah.
Just my first thought is, okay, so you're running a bakery and then you're pivoting into frozen foods. How are you getting this insight?
So, we quickly learned, after a few months of operating the business, that there are a lot of guys driving around with trucks trying to sell you a pallet of flour or sugar or yeast, and anything that goes into the bakery business. And my margins, quickly went from, the mid 30s down to the mid teens after, some competitors saw blood in the water and saw that, a new guy who's never run a distribution company before, hey, we can try to get this guy out of the market and try to take his share. So we looked around and said, what do the big guys, the Cisco's and the GFS's, not do very well? And we quickly discovered it was frozen foods. I went around and asked every single chef, food and beverage manager, supplier as to what are the big guys not doing very well? And the responses were always frozen foods. It was either they had very little space in their warehouse, on their trucks, a very minimal amount of inventory and lines that they carried. And we saw, hey, if we really went wide with the frozen food business, we can carry a lot more inventory and a lot more different lines, so that the chef doesn't have to, basically carry the exact same thing that every other chef does from a frozen foods perspective.
Sure. That makes sense. And do you focus on one particular product line in particular, or were you pretty broad as far as the frozen foods?
We started off with what would work well for our existing customer channel. So, going into bakeries, what frozen foods would they want? There are some extremely labor intensive lines in the bakery. Let's take croissants, very, very difficult to make. So most of them are actually frozen and kind of pre-baked and thawed at the facility, not actually freshly made. So we started there and started getting some traction. But after a while, that's a limited market. So we actually ended up going quite wide and carrying everything from frozen fruits and vegetables all the way to to muffin mixes and anything else that a restaurant or a bakery would need. So we went pretty wide with our inventory selection, but it really started off with just selling into your channels that you already have and those relationships that you've already built.
Okay, gotcha. And then you ended up selling the frozen foods company, right?
Yeah, that's right. We weren't intending to sell, but we were getting offers for it, and eventually get an offer that you can't refuse. So
Sure.
we ended up selling and leaving, and that's what got me into the distressed world that I'm currently working in.
Great. And how did you get your start? What was your first turnaround?
So first turnaround was a medical device company. So this company was run out of Florida in the spine business. So they were doing spinal and hip implants. It was started off by an extremely intelligent PhD in biomechanics who went in and developed a really cool system on how to actually get a spinal implant in with a far less invasive surgery. However, for as good as he was at developing a product, and he was extremely good at borrowing money, he could never actually monetize the product. He couldn't build the processes, build the sales channels, develop a team, and just start monetizing all his great inventions. So the bank ended up calling us and saying, "Hey, we've got millions of dollars forward to this company. He just can't seem to ever turn it around and make money out of it. We need somebody to professionally to come in and build those systems for him, so that we can actually get above water on our bank covenants that we had set off on our agreement, and actually start having him make interest and principal payments, because they had done term loans to finance the business."
Hang on, and how do you even get into that position in the first place, to be able to be in the position for a bank to call you up and be like, "Look, we need you to go in there and turn the business around"?
So there's a position in each bank, any decent sized bank, called special assets. So special assets is when, if you ever borrow money from a bank, you're likely borrowing it from your local branch or online, but you're often assigned what's called a relationship manager. The relationship manager is going to be your best friend. They're going to, send you a Christmas card every year. They're going to take you out for golf trips, or, send you to the latest sporting event. as soon as you stop making principal and interest payments, or you kind of fall below what the bank requires in terms of covenants, they're actually going to kick you out of the relationship manager's jurisdiction and into what's called a special asset group. Most banks have one. If it's a smaller bank, it's often managed by a chief credit officer. But what we try to do as a turnaround firm is be very visible to every single special asset division in any bank across the country. So these guys know that, hey, as soon as I have something hit my books as a special asset group, I got a turnaround firm like Newpoint who will come in and actually either manage the company or kind of coach the current executives. In this case, we actually assumed the CEO position.
Hang on, and on a very practical level, right? So you exited your first business, you're sitting on like a lump sum of money, you're deciding you want to go into, you want to help turn businesses around. Do you just reach out to dozens of banks and just cold call the managers to get an in, or how did that happen?
Yeah, you can either cold call them and make yourself visible to them. They're often on LinkedIn, and they're you can find them under special assets or financial restructuring. They're all that's the beauty of marketing to that position, is that they're often very visible and very active on LinkedIn. So you make sure you have a LinkedIn account to be visible to them. But really, you're just getting on their radar so that when a deal comes up, and it's a very much an event-driven business, so when they have something for you, you'll be their best friend. But when they have when they have nothing for you, it's like you'll likely hear crickets from them. But getting into the distress space is really being very visible to these guys and letting them know, hey, I've got capital or a way of turning the business around. Because all these special asset bankers want to do is just get the file off their books and back to that relationship manager.
Sure. And with that first deal, did you because I'm assuming going off of your LinkedIn, you don't have a background in biotech and biomechanics. How did you know this was going to be a good deal for you to turn around?
Yeah, often a lot of the times is we don't need to know this very specifics of the deal. When you're buying a distressed business, you're not founding anything. You're buying something that's already got something, some product on the ground, and really you're just trying to apply some very sound business practices to a company that has not had sound business practices. So as long as you come in with a structure and a way to control cash and a way to apply some type of sales or marketing or operational structure to a business, you often don't need to know the specifics of it. I never spent one day in biomedics before running a biomedics company. The very specifics of the industry, I was relying on the already established team to kind of fill those gaps in for me. All I came in to do to fix the business was apply very broad, well-honed business strategies to be able to monetize what this owner had done and get the company cash flowing again.
Okay, and let's talk about those well-honed, sound business strategies and practice. So you're going in there, you have like 100, 200 days to turn it around. What are your first couple of moves?
Yeah, always first move with a distressed business is you've got to get a handle on your cash. The first thing you need to do is establish a 13-week cash flow model. It's the reason why I say 13-week cash flow model is because that's a very standard piece of documentation that banks will want to see to have, for them to understand what are the what's the in and out of cash as the business continues to operate. Because really, when you're, the risk of dealing with a distressed business is you've got a secured lender secured against some collateral in the business who can foreclose and actually shut that business down. A special asset bank.
Does that just mean this, might sound dumb, but does it just mean to have 13 weeks of cash in the bank, or does it mean something else?
It means you are forecasting out 13 weeks of what the next 13 weeks are going to look like, to see what my bank account is, what am I going to collect from cash, and what am I going to disperse with cash.
Gotcha.
At the end of the day, you're going to see how my operations are doing with the 13-week cash flow model. Am I generating cash, or am I losing cash from from operating over the next 13 weeks? And it'll be a rolling 13 weeks. So the reason why it's rolling is because you need to keep the bank and any other secured creditors very aware as to what's happening with the business, in a case of I need your support not to foreclose on the assets.
Yeah, that makes sense, because they could come in at any point in time and just foreclose on you, right?
They have a lot of power to be able to just shut the business down and sell off the assets, and basically recover what they think is reasonable to pay back their loan.
And then in this case, do you make money on the spread, as far as like what the bank thinks the assets are worth, and then what you end up generating at the end? Or how are you making money? How are you getting paid?
So you try to take some type of management fee when you actually start running the business, but the upside really is on the acquisition of the business, and then the selling or the refinancing out of after that 100 days. Often what we do, or what our clients are doing, is joining the equity stack at the beginning of the deal, stabilizing the business, and then ultimately holding it for the long term. There's not a lot of selling that goes on after 100 days. That's too short of a timeline. And the reason why I keep quoting 100 days is because that is often the time that the bank will stand down to say, this is how long you have to take to fix the business. And as after the 100 days, we'll kick you back to a relationship manager and let you kind of proceed going forward. I've seen up to 300, 400 days for a bank to stand down, but 100 days is generally kind of a good rule of thumb for you to come in and apply those, good business practices to get the company to stop bleeding cash and make the bank want to stand down.
Sure. So that means you come in with a pile of cash, you buy into the business, right? You get some equity, you fix up the business, and then after 100 days, you refinance or sell off the asset, but most likely refinance. Is that correct?
That's correct. Often the balance sheet as you enter the transaction doesn't have any more assets to be able to lever to create more working capital. Doesn't have enough cash to be able to get to the next quarter, or later on in the year. So you coming in as a part of the equity stack to be able to join that equity group, you're really putting cash on the balance sheet for them to operate. And then your goal, again, over a certain period of time, let's call it 100 days, is to stop the bleeding of the business and get it to cash flow on its own. And that's what actually really starts to create the value, because you're entering into distress and you're trying to leave as non-distress, and that's your spread. And it's often it's a company's not ending up in distress because Amazon enters the market, or there's been some major change in an industry. A lot of times what we see is that a business has ended up in distress is because the ownership has taken their eyes off the ball, or they've made some really poor moves with working capital that has ended up with a cash crunch. There's often much more micro reasons and just really fixable reasons that they can't seem to get themselves out of, that has caused a business to be in distress. And that's your upside.
Yeah. And gotcha. And can you to buy into the business, is that 100% cash, or can you apply some leverage by maybe taking out a loan and only putting, say, I don't know, 20% cash and the rest is financed?
If you apply leverage to the business, likely the bank that's already referred you in has taken a secured position. There's likely not a lot of assets to be able to for you to get any type of collateral. So you're all, if you're going to put money into it as a debt holder, you're often coming in as unsecured, which means if the business does have to liquidate, you're going to get nothing on your dollar or pennies. So, often if you come in as debt, that's still putting pressure on your week to week cash flow model. And what we see a lot is the current, the ownership of the distressed business has already tried to go after a higher interest debt just to try to keep money into the bank. There's lots and lots of guys out there who are happy to lend you 15 to 20%. But that is that's, you're starting to go down the slippery slope as a distressed business, because you're putting more and more pressure on your balance sheet, on your cash flow, just to make to the next quarter. If you come in as long-term equity, that means it doesn't have to flow through the income statement. It puts a lot less pressure on your 13-week cash flow model and allows you to see the upside at the end of the day when you actually sell off the business.
Sure. So that's your way of saying you don't generally apply leverage, right? And you go all cash.
Yeah, I mean, you might as well come in as equity, because the case of an unsecured, which you're likely going to be, or equity, you're in either case under a liquidation scenario. If God forbid the business does have to shut down, let's say you can't turn it around, or the situation is just too dire, you're going to end up with the same amount of collateral at the end of the day, which is likely very little to nothing. So you might as well come in as equity and try to get the upside at the end of the transaction, and that you're not putting pressure on the cash flow from interest payments.
Yeah, makes sense. So what is the upside, generally speaking, as far as, maybe, I don't know if you can talk actual dollar amounts or not, if you can take maybe percentage points, as far as you go into the business, you buy into the business, you exit the business, or you refinance 100, 200 days later. What are we talking ish, so we can get an idea?
Yeah, so you're trying to buy for pennies and sell for dollars. So you're trying to kind of come in and the more distressed the business is, the cheaper obviously you're going to get it, but the bigger headaches that you have to deal with. So it's really how much risk do you want to take when you're buying one of these distressed businesses, or how much cash do you have to be able to weather future storms for the business before it actually gets back on its feet. So there are definitely components to a distressed business that you'll want to take a look at to see if you can get a better deal. And I often like to look at, does the current ownership have a lot of personal guarantees on the loans? The more the personal guarantees, the more they put their own balance sheet, their house or the kids' college fund, or their boat house, or something on leverage to the bank, so that if the business ever has to liquidate, they have to sell all that off. So the more personal guarantees, the better purchase price you often get, and that's the higher the upside. But really, the goal is to buy for some type of liquidation value, or book value of the business, and sell it as a going concern, which could mean many multiples on your money if you're able to do the correct turnaround and actually start realizing actual free cash flow in the business.
Yeah. What I'm still baffled by is how you can just go into a business that back to the biomechanics, biotech business, you can just go into that business and flip it, turn it around, without actually knowing about this very sophisticated domain itself. Can we talk a bit more about the business fundamentals, because this seems very, very genius to me, because basically you're saying there's a lot of mismanaged businesses. It doesn't matter the industry, we can just go in there, apply sound business practices, and make bank, right?
Yeah, back to the biomedical device company, is I didn't need to go in and understand how to graft a implant onto somebody's spine. That work was done already by somebody who knew how to do something like that. those patents had already been filed, that those assets were already on the balance sheet. What this company didn't know how to do was didn't know how to hire a sales team, didn't know how to create a sales funnel, didn't know how to run operations properly, to get it, raw materials into inventory, didn't know how to forecast inventory, didn't know how to create a finished good in a reasonable amount of time, and didn't know understand how to run a cash flow model, didn't understand how to run a 13-week cash flow model. So there were a lot of fundamentals of the business that were missing from this particular case, that if you go in and you apply just those fundamentals techniques, I didn't really need to understand how to graft something onto somebody's spine. All I needed to understand was how to develop a sales team and run a cash flow model.
Yeah, makes sense. And were you able to take a look at the financials prior to buying into the business?
Yes, absolutely. So that's always a key component of it is, as soon as you sign an NDA with the bank and you're interested in pursuing it, the the financials are shown to you, that those are accrual based. You've got to convert accrual based financial statements into a cash 13-week cash flow model, because that then you're actually starting to look at cash in and cash out instead of any type of accrual based accounting, and then understand what do I need to apply to this business in terms of more working capital to then start hiring salespeople, hiring an operations manager, upgrade tech, apply an inventory forecast module from some type of ERP system. That takes all that does take some cash. So I got to understand what my purchase price is, and then how much additional I need to put in to get it turned around and cash flowing again. So as long as my cash flow model starts to show positive over time, whether it's that 13 weeks, whether it's 26 weeks, or whether it's a whole year, and that really is a conversation with you and your banker, and that's on a case by case basis, then that's you applying that fundamental sound business practices to the business will allow you not to have to know how to get a patent on a medical device.
Yeah. Let's switch gears a little bit. You had posted in the trends group that there's a lot of opportunities right now as far as buying distressed businesses because of COVID, obviously. What are some of those opportunities that you're seeing right now? And then the follow-up question will be, how can we get involved?
Yeah, so there are a whole bunch of different businesses prior to COVID that were distressed for very good reasons. Either they were just extremely mismanaged, or they were in a bad industry. But that case has changed quite a bit with COVID. COVID has pushed a lot of good businesses that never would have been ever in front of a special asset banker into distress. So one situation we've got right now is I'm the CEO on a organic supply CPG company that sells organic snacks in through Target, Walmart, Whole Foods, Amazon, but they also sold in through schools, hotels, airports. If you went through the airport, you would have seen their product on the shelf, in one of these kiosks. Unfortunately, a lot of those channels have shut down, and obviously, hopefully temporarily. But it's a case where that loss of sales pushed what was otherwise a very good business through the special assets, because all of a sudden, half your sales go away because those channels shut down because of COVID, and now the bank is looking and saying, "Hey, you severely broke down your bank covenants on our last quarterly review, and you're in a cash crunch situation." So that's where we come in. We see, okay, there's definitely upside to this. We don't expect airports to be fundamentally shut down for the rest of our lives. It'll take a little bit more time. We do expect continued cash burn. How much more cash do we need to put in this business to be able to still keep the lights on and keep the other customers, the Targets, the Walmarts, the Whole Foods, still still with supply, and that's basically our entry point into this company. So I'm now the CEO of this company, and we're just applying good fundamental cash management to these guys to reduce the amount of cash burn, and get us back into a position where where we can actually start selling into the airports and the hotels and the schools once they start reopening up.
Yeah, that makes sense. Are you actually looking at buying an airport right now?
It's really, we're just selling into airports. It's none of those none of those types of companies have actually presented themselves to us. I'm not actively looking for anything specifically. I'm waiting for the special asset bankers to tell us what they have on their file.
Okay, so you're completely agnostic as far as the industry.
That's right.
Okay.
I'm more worried about how the deal can be structured and is this business can be turned around, rather than worried about any types of specific industries. In our firm, we're managing anything from from construction projects that went awry to CPG snacking companies that sell into airports. So pretty a broad range of different types of businesses. But again, it's just applying good business fundamentals and knowing what to look for when you're trying to structure a deal, just to make sure that you don't get yourself into too much trouble.
Yeah. And how can people without a sophisticated finance background get involved in this business if they want to get some upside from distressed businesses?
Yeah, so I am putting a program together called Hack the Capital Stack. You can find the sign up details on my Twitter page or my Substack page. It's a case where I am laying out what you need to look for when you're structuring the deal to again keep yourself out of trouble, and then ultimately what are those 5 to 10 components of a good business management that are going to yield you the greatest results. So kind of that 80-20 Pareto rule is what are the things that you need to ultimately go in those first 100 days or first 200 days. Really depends on the negotiation with the banker, and then also how to speak with your stakeholders. Speak with the employees, speak with the creditors, whether secured or unsecured, and ultimately how to present a turnaround plan and what those components of the turnaround plan are to be able to then start to fundamentally turn around a business. In the program, I lay out who should be on that team, but ultimately, if you feel that, hey, I've got capital I want to put into this business, but I'm just not comfortable at the execution component, firms like myself, like Newpoint, Alvarez, ITT, are available for hire to be able to actually do the management of those. If you just feel like I'd rather just put the money in and let somebody else deal with those negotiations and structuring the deal.
And what's the minimum buy-in with your firm currently?
Typically, we won't look at any firm that's doing under 5 million in revenue. That's those types of business are just too small to be profitably turned around. So the sweet spot, I would say, is really kind of 20 million to 100 million in revenue, but 5 to 20 million is still very much a possibility. We just have to take a real harder look to make sure that there's still cash at the end of the day to get this company out of the distressed position and stabilized.
Yeah, and speaking of Twitter and speaking of the 80-20 Pareto Principle, we'd actually gotten this question on Twitter earlier because I tweeted out about questions. Yeah, can you actually tell us about this? What is the 20% that will yield 80% of the results?
Yeah, I'd actually respond to that gentleman. Really my first response there was get your cash flow model up and running. That is your key tool to understand when am I going to run out of cash, because cash is king, that old mantra. Understand what your cash balance is, what your burn rate is, when are you going to stabilize, and how much how much collateral and protection does your creditors have, so that you can really understand what your bottom line is from a cash perspective. I'm actually not even worried about, and I actually spend very little time with the accrual financials during a turnaround. Not to say that they're not important, but the cash flow model is ultimately really what you need to understand and to manage to get through a turnaround. Once you establish a cash flow model, then you have to start playing around with the variables to say, do I need to get paid faster? Do I need to stretch my suppliers out if that's a possibility? Do I need to cut costs? Do I need to increase revenue? What are the fundamental business systems that you need to put in place quickly to be able to start improving your cash position and get stabilized? Because as soon as you get stabilized, then you can have a much better conversation with your banker to say, Mr. and Mrs. Banker, I need you guys to stand down, put me back with relationship banking, and let us then start running with the business and allowing it to grow again, so that you're buying for pennies and selling for dollars.
Yeah, that is a nice 80-20. Obviously much easier said than done. That's why, professionals such as yourself exist, obviously. Actually, I have one last question, very personal question, actually.
Sure.
So I have some, basic finance knowledge, but I actually studied computer science in college. However, my dad is a CPA, so he taught me kind of like the fundamentals. What are some resources that non-finance educated folks could check out to get a better understanding of this?
Are you talking about distressed turnarounds, or are you talking about just like finance in general?
I'm talking about finance in general, because that seems to be the prerequisite to understanding this and succeeding in this space.
One book I like, which is more on I like how to operate a business, is from good to great. I think that's a really strong book. Another fella in my industry wrote a book. His name's Jeff Sands. He wrote a book on how to fix any business in 100 days. Obviously, my stuff is I think will show you a lot as to how to do it. And then read anything on the on like investing, like Warren Buffett style. I think he's obviously like classic value investor, but just like the components of how to look at a business from its book value to understanding the difference between book value and a going concern value will help you a lot on just trying to comb through deals and just kind of understanding how you can turn pennies into dollars, basically.
Yeah. And is there businesses around that you can buy for, say, $100,000, or would you need 7 figures to start doing this?
If you want professional advice, it would be 7 figures. But yeah, trust me, there's a lot of smaller businesses out there that you can start with $100,000. That it's and again, I've seen businesses being sold for $1, but that that $1 means any lawsuits or any creditor who comes out of the woodworks after you buy it is your responsibility. So you could be, exposing yourself to risk for hundreds to millions of dollars. So I never recommend doing that. But it's there's definitely lots of businesses out there that are struggling in that 100 to 500,000. But then you're kind of pretty much on your own to turn it around.
Yeah, makes sense, because the big players aren't interested. It's not enough upside, right?
Yeah, and then if you want to hire a turnaround professional, there's just not enough cash flow in the business to be able to justify that expense. So if you've had some experience, either corporate or entrepreneur running a business, and then you want to buy a distressed business in that 100,000, then you're actually, that could be a space for you.
Yeah, gotcha. All right. Well, I'll have to make some more money then first.
Yeah. Those smaller businesses tend not to be through special asset banker. They're just too small. The bank's going to just write them off. But just keep your eye out on just business broker websites, or just classifieds, to see who's put their business out there. Because often when somebody's trying to sell their business, there's something wrong with it. It's not that they're at the top of the market and all of a sudden they want to sell high. It's like they're trying to dump it.
Yeah. And obviously there's all kinds of, this is kind of like my biggest nightmare, right? You buy into a business and then there's all kinds of lawsuits, all kinds of shit happening, and you're stuck, right?
Well, that's that. Yeah, I show that in the course as to how to get around that. You're either doing an asset sale or you're putting a whole bunch of reps and warrants on a share sale to protect yourself. But that's like 100% a part of what I'm trying to teach here is you have to protect your downside so that the pennies don't become dollars, if you know what I'm saying.
Yeah, I know what you're saying. But like, so there is a way of knowing about potential lawsuits ahead of time.
Yeah. I mean, the known lawsuits is one thing. Like this company we just bought into actually has a lawsuit on it. So this the CPG company I was explaining has a lawsuit on it. So we're actually pushing it through. We bought it with reps and warranties, so that our firm is not personally responsible for it. But you can also push it through what's called Subchapter 5 bankruptcy. And again, it gets a little dense, but I'll show that in the course as well as to how you can actually protect yourself and keep your equity in the company.
Nice.
It's a new law in the U.S. bankruptcy codes that actually just came out just pre-COVID, so it's pretty new. So that's why it's a part of Chapter 11. I don't know if you've ever heard of Chapter 11 or not.
Yeah, of course.
It's a subcode to 11. But it'll if I put $1 million into a company pre-bank sub 5 chapter bankruptcy, I still get to keep that million at the end of the day afterwards.
Yeah. No, that makes total sense. But yeah, any final thoughts? You were talking about the program you're starting. When is that going to open up?
Yeah, I provide a lot of free content already. If you wanted to sign up for my Substack, and again, you can find the link through my Twitter at Michael Yarmo, or my Substack, michaelyarmo.substack.com. Feel free to send you the free stuff. The way to structure the deal, the way to control risk, and the real components of what to look for from a turnaround deal and which stuff to avoid. And then ultimately I get into case studies and some other specifics about how to manage the rest of the capital stack, specifically your secured creditors, will be made available in the next couple of weeks. One thing I did we haven't touched on that I wanted to include into the course is Subchapter 5 bankruptcy. So that was just something that's I needed to get a little bit of understanding, because we're actually going through one right now. That is a component of the bankruptcy code that actually allows the equity holders to stay whole after you file. And there's actually some really nice upside that can be that can be structured into those types of deals that I'll kind of walk you through into the course.
Nice. And we'll link it all in the show notes, of course. Yeah, Michael Yarmo, thank you so much for coming on the show. Learned a lot today about finance. It was a bit, heavy at times, but I think you did a great job explaining it. So thanks again for coming on.
Oh, thank you. Yeah, there's definitely a lot of heavy components to it, but just keep in mind there's a lot of resources out there to help you. And it's really just comes down to, if you're familiar with and good at setting up structures for businesses, then entering this distress space actually becomes a lot easier, because all you're just going to do is apply those good fundamental business structures to businesses that likely never had them before.
And if you're a someone without any business experience, would you suggest the first step is to get that business experience, or can you start out as a turnaround investor straight away?
You can still start as a turnaround investor, but I would highly recommend any of the turnaround process leveraging a turnaround professional to actually handle the process for you. I wouldn't dare do that if I don't have a good fundamental understanding of how to run a business. But again, there's lots of turnaround resources out there to help leverage if you want to enter this space without actually operating the business.
Sweet. And again, we'll link a bunch in the show notes. Thank you again so much, Michael, and have a fantastic day.
Thank you very much. Appreciate it.
Thanks so much for listening. If you like the podcast, please subscribe and leave a review on iTunes or Spotify, and share the episode with someone you know. It would really help me out a ton. New podcast coming out every Monday. See you next week.